Does cash-out refinance affect FHA loan eligibility? Are you curious about how a cash-out refinance could impact your eligibility for a Federal Housing Administration loan? Let's break it down in simple terms. A cash-out refinance allows homeowners to replace their existing mortgage with a new, larger loan. The difference between the two loans is given to the homeowner in cash. This can be a smart strategy for managing debt, as it lets you tap into your home equity for various needs like paying off high-interest debt or making home improvements. Now, when it comes to Federal Housing Administration loans, cash-out refinancing is allowed, but there are specific rules you need to know about. First off, credit score requirements are essential. The Federal Housing Administration generally requires a minimum credit score of 580 for a cash-out refinance. However, many banks and credit unions may ask for a higher score, usually between 600 and 620. This is because cash-out refinancing is seen as riskier than standard refinancing or purchase loans. If there are multiple borrowers, lenders might consider the middle or lowest credit score among them. Next, let's talk about the loan-to-value ratio. With an FHA cash-out refinance, you can typically borrow up to 80% of your home's appraised value. This means you need to have at least 20% equity in your home to access cash through this method. For example, if your home is valued at $400,000, the maximum loan amount would be $320,000, leaving the rest of your equity intact. Another important factor is the debt-to-income ratio. Banks and credit unions will look at your monthly debt payments compared to your income to ensure you can handle the new loan. A lower debt-to-income ratio is preferred for getting approved. Also, keep in mind that non-occupant co-borrowers or co-signers cannot help me. The Federal Housing Administration credit underwriting guidelines for cash-out refinances. Only the homeowner's financial situation will be considered. From the perspective of banks and credit unions, cash-out refinancing is a product they offer to help customers manage debt or access home equity. However, due to the increased risk, they may set stricter requirements than the Federal Housing Administration minimums to protect their interests and ensure borrowers can repay the loan. If you are thinking about a cash-out refinance for managing debt, it is wise to check your credit score, calculate your home equity, and review your monthly budget. Banks and credit unions will guide you through the process, explaining each step and helping you understand if this option is suitable for your situation. In summary, a cash-out refinance can affect Federal Housing Administration loan eligibility by introducing stricter credit, equity, and debt requirements. Understanding these factors can help you make informed decisions about your financial future.